Welcome to our latest explainer. Today, we're unpacking a really fascinating high-stakes paradox right in the middle of the biotech world. We are looking at a company called Stoke Therapeutics. Now, this is a business that is intentionally burning through millions of dollars. Yet it's being valued entirely on what it might achieve tomorrow, rather than what it's actually earning today. We're going to dig right into the source materials to see exactly how Wall Street evaluates a company that is essentially chasing medical miracles. Okay, so let's just jump right into it and ask the core question that really sets the stage for our whole explainer today. How in the world can a company that is operating deeply in the red command such a massive valuation on the open market? I mean, in almost any other industry, widening quarterly losses would send investors literally running for the exits. But the biotech sector, well, the rules of gravity are just a little bit different there. Heavy spending isn't always a giant red flag. Often, it's just the required fuel for a very complex scientific engine. To put that into perspective, we are talking about a $1.85 billion market capitalization. That is a massive number, and it totally anchors us in the intense financial reality of biotech investing. This valuation actually makes Stoke one of the top 5,000 most valuable companies globally. And the stock itself has seen some wild swings, up over 150% in a single year, which really just shows you the intense market anticipation surrounding what this company's science might actually be able to pull off. And despite those constant ongoing financial losses, the consensus from Wall Street is overwhelmingly bullish. Out of 13 recent analyst ratings, 11 are strong buys, 1 is a moderate buy, and there's a single hold. Notice there are absolutely 0 sell ratings. With a high price estimate reaching $60 a share, Wall Street is signaling massive upside potential. So we have to ask, what exactly are all these analysts so eager to buy into? The justification for all that optimism lies in Stoke's completely proprietary approach to RNA medicine, using a platform they call Tango. Instead of just putting a Band-Aid on the symptoms of a disease, Stoke's therapies are actually designed to upregulate or increase naturally occurring protein levels in the human body. They're going after diseases that are caused by a 50% loss of normal protein levels, a condition known as haploinsufficiency. By targeting the literal genetic root cause, they aren't just trying to manage severe diseases, they're aiming to fundamentally modify or even halt them. That scientific platform translates into 2 primary value drivers for Stoke. First, you've got zorevunersen, their lead candidate targeting Dravet syndrome, which is already pushing through late-stage phase 3 clinical trials. And then you have STK-002, which targets a severe progressive vision loss condition. That one has just entered phase 1 testing. These 2 drugs essentially represent the entire immediate future of the company. Section 1. Zorevunersen, targeting Dravet syndrome. So, Dravet syndrome is an incredibly severe, life-threatening childhood epilepsy, and right now, there are 0 approved disease-modifying treatments for it. None. But Stoke actually has hard data to back up their ambitious goals here. Recent results from their Phase 1 and 2A trials were just published in the very prestigious New England Journal of Medicine. The data showed substantial, highly durable reductions in seizures alongside lasting improvements in cognition, behavior, and motor skills over a 3-year period. So this is no longer just a cool theory. This is proven efficacy in human trials. And the timeline for this drug outlines an accelerated journey with the FDA, which completely explains why analysts are watching it like a hawk. After snagging a breakthrough therapy designation in late 2024, the next huge immediate catalyst is completing their 150-patient enrollment for the Phase 3 study by the second quarter of 2026. If they hit that mark, we're expecting a massive data readout in mid-2027, followed quickly by a rolling new drug application. That rolling submission means they can send sections of their application to the FDA as soon as they're ready, rather than waiting to submit the whole thing at the end. In the biotech world, time is literally money, and this kind of accelerated schedule is a huge reason for the stock's premium price tag. Section 2. STK-002, reversing vision loss. Okay, let's pivot to their second major pipeline asset. This one targets autosomal dominant optic atrophy, or ADOA. And you guys, the stakes here are so incredibly high. It's the most common inherited optic nerve disorder out there, affecting roughly 1 in 30,000 people globally. It usually hits kids in their first decade of life, causing progressive, totally irreversible vision loss. By age 10, about half of these patients will be legally blind. And the current standard of care? There isn't one. There are absolutely 0 approved treatments. To tackle this, Stoke just dosed their very first patient in the Phase 1 Osprey study, happening across the UK and Germany. Now, the main focus is pretty standard for early-stage trials. You got to ensure safety, check tolerability, and see how the drug is acting in the bloodstream. But the truly exciting part is that they'll also be tracking secondary objectives, like actual changes in visual function and the physical structure of the eye. They are hoping to restore specific protein levels to stabilize or maybe even improve the patient's vision. If it works, it would be an absolute game changer. Section 3. The cost of innovation. Stoke's financial reality. But obviously, science at this elite level does not come cheap, and it creates some wild earnings volatility. Just look at the swings over 2025. In Q1, they posted a huge $190 per share profit, but that was driven by a one-time milestone payment from their partner Biogen. Once you move past that and through the rest of the year, you see these rapidly deepening losses. That's entirely because their research and development spending heavily ramped up to support those expensive phase 3 trials. Which brings us to an expected per-share loss of 80 cents for the first quarter of 2026. This number proves without a doubt that their aggressive cash burn is a deliberate, fully expected reality. Stoke is purposefully spending a fortune right now to fund these clinical trials. The market isn't punishing them for being in the red. Honestly, investors are just watching closely to ensure all that money is effectively moving the science forward. And despite those mounting financial losses, the company is actually quite well capitalized for the near future. They're sitting on over $246 million in cash reserves. That gives them a solid financial runway to fund their operations all the way through mid-2028. And that timeline is absolutely crucial. Mid-2028 extends safely past their expected mid-2027 phase 3 data readout for their lead drug. Plus, that financial cushion is partly secured by their commercialization collaboration with Biogen for markets outside of North America. Now, because of these completely unique financial mechanics, trading the stock around earnings reports is a wild ride. The historical volatility is fascinating. The stock's average move on the actual day of an earnings release is pretty mild, about 2.8%. But the day after, once analysts have had the chance to digest the management commentary and the clinical trial updates, the move more than doubles to nearly 6.4%. It just goes to show, in this space, investors care way more about the pacing of the clinical trials than they do about the actual earnings per share numbers. And that dynamic perfectly sums up our explainer today. There's a great piece of analysis from Barchart that noted Stoke's mounting losses may actually validate its platform better than a profit would. That really hits the nail on the head. The intense spending is the exact proof investors need to see that the company is fully committed to pushing these breakthrough disease-modifying drugs across the finish line. If they were turning a profit right now, it would basically mean they'd stopped investing in their own future. So we are left with the ultimate risk-reward paradox. Will Stoke Therapeutics' clinical momentum cross that FDA finish line before the cash runway finally runs out in mid-2028? They clearly have the science, they have the highly promising early data, and they definitely have Wall Street's backing. Now it is just a high-stakes race against time and biology. Thanks so much for joining me on this explainer. We'll catch you next time.